You've probably heard of franking credits, and you've probably heard that they're a pretty good thing. This video will explain them in under 3 minutes. Franking credits, a unique feature to the Australian tax system, are designed to ensure that company profits aren't being double taxed. They impact the dividends that investors receive, which in turn impacts overall investment returns. Imagine a company makes $100 in profit in a given year. The Australian Tax Office will charge that company 30%, the full corporate tax rate. After tax, the company has a net profit of $70. Say the company wants to then pay out its profits to shareholders as dividends. That dividend would be taxed a second time as investor income at the investor's marginal tax rate. But in Australia, franking credits are designed to prevent this. The ATO recognises that the company has already paid corporate tax and gives them $30 in franking credits. The $30 of credits are distributed to investors along with the $70 of cash. Investors then take the credits and can use them to offset the income tax they would have to pay on the income from the dividend. In this example, if an investor has a marginal tax rate of 30%, they wouldn't have to pay any additional tax on the distribution. They would receive $70. If the investor has a marginal tax rate lower than the 30% corporate tax rate, even better. That investor could be entitled to a tax refund equal to the difference between the corporate and marginal tax rate. On the other hand, an investor with a marginal tax rate above 30% would need to pay the difference to the ATO. Either way, franking credits can help you generate better returns on your investments by ensuring that you're not being double taxed on those investments. You might have heard shares and ETFs offering franked or unfranked dividends. A fully franked dividend means that the company has already paid tax on the profit and decided to pass the credits to shareholders at the maximum rate of 30%. Unfranked dividends mean that no credit is passed on to shareholders by the company. If you're receiving franking credits, you can report them at the end of the tax year and potentially offset your tax bill. If you have any other questions about franking, leave them in the comments. But for now, that's franking in under 3 minutes.